Hello, I am Sensei Kevlar. Welcome back to the Dojo. Got a lot of stuff to cover today, so let's get right into it. In the first lesson, I showed you how to find resistance and support and how to use it to make a plan, using dollar cost averaging in order to create your opportunities when the market goes in either direction. Today, I really want to codify that idea and show you how to do this, and we'll have our first brush with automation. We'll talk more about the automation mindset later, but right now what I want to show you is I want to show you the pain associated with doing this by hand. Of course, if by now, hopefully, you've taken the time to go and find resistance and support and started to make a plan based upon, the reality, the fiction that you told yourself on the charts, and figuring out how to make yourself profitable. What I want to show you is I want to show you how to codify that and how to test that scientifically. So let's just dive right into that before we get into more trend-based analysis. What I've got here is I've got a planning worksheet. Took me about 20 minutes to make this thing, typing in all the equations and everything. But I'm just going to make up some numbers here. Maybe these numbers don't actually inform reality, right? But let's assume that we're dealing with this market, ETH BTC. Let's assume that the price is, presently 0.033 ETH per BTC, okay? That might be high, it might be low, I don't know, doesn't matter. The point is that what we're going to do is we're going to take the numbers off of the chart and we're going to put them in here based upon our support lines where we think the chart might turn around, okay? We're going to say the first place that we're going to buy one position is we're going to buy one position here, and we're just going to put that number in here. You can see we're actually just putting the numbers directly in from our resistance lines, taking them right off the chart, okay? Then the next thing that I did is I went and I made a multiplier, and I said I want to multiply by my position by 2, okay? So then what I did is I just made a formula that said, C5 times D1, and that gives me my multiplier, how much I'm multiplying my position by, okay? And then C6 times D1, well, I'm just taking that and I'm multiplying it by this. And then C7 times D1, well, I'm just taking this and I'm multiplying it by this. C8 by D1, and all the way down in order to multiply my position. The result is that if I were to change this right here to B3, what would happen is the amount of positions that I'm buying changes as a result. Now I'm multiplying by 3 in my dollar cost averaging. I'm going to stick with 2 right now. So what I'm saying is I'm going to buy one position, which means I'm going to buy, 0.33 BTC worth of ETH, okay? Which is going to make my total cost 0.33, which is the sum of how much I've spent, right? Because this is how much I'm spending each time, is I'm spending this much times this much. Just a simple equation right here in Excel. This much times this much, right? How much I'm paying versus how much, times how many positions I'm buying. And that gives me my total cost over here, which is the sum of D5 to D8 in this row, because that's how much I've spent so far. This is how much I've actually spent. Well, the amount that I've spent so far divided by the total number of positions that I've acquired, well, that's the sum of C5 to, sum of C5 to, sorry, that's E6 divided by the sum of C5 to C6. Because what I'm doing is I'm adding up the number of positions and I'm dividing my total cost to figure out my dollar cost average. This is my DCA right here, okay? All I'm doing is just putting these numbers into an Excel sheet. You could do this in about 5 minutes if you took the time to actually do it for yourself, okay? Then I'm saying I want to sell at 10%. So I just put this value up here, just typed it in, 10%, okay? And then I said I'm going to sell at 10%. And then I'm going to, what I'm going to do is I'm going to take how much I actually own, my actual DCA position, my actual dollar cost average position, and I'm going to go ahead and multiply that, add 10% onto that, right? So I'm going to say, figure out what 10% of that is, and then add that on. And that's where I'm going to sell. Okay? So if I buy one position here at this place, and then it goes up from here, this is how much I make. This is, again, a simple equation. This is E5 times F1, which is how much I've spent times my profit multiplier. Okay? Here, I've spent this much, and I've made this much. Here, I've spent this much and made this much. Here, I spent this much and made this much. All the way on down the line. Okay? All I have to do is, if I want to see, if I wait until it's 15% profitable, well, I can see how much more money I make, right? If I wait until it's 20% profitable, I can see how much more money I make. Well, I like that. I like making more money, waiting for it to be more profitable. But now it has to go up higher, right? So let's just stick with 10% because that's a good number, and I'll show you why in a minute. Okay. Meanwhile, my multiplier over here, my total cost right here, this is the critical number. This is what you have to be paying attention to. Look, if you don't have 0.469 BTC allocated for this opportunity, you can't execute this plan. This plan's no good. This is what matters. This is what informs your portfolio actuality at the bottom of the market. When you've spent all of your money, well, you better have this allocated. This is part of the plan, right? So having the foreknowledge of this number right here and having the foreknowledge of this number right here allows you to go back and figure out where this actually would have occurred. If this was a good plan, then you can go and you can apply this to an actual market. You can come over here and you can say, ETH BTC, and then see if that plan, which you took off of here, really got executed and really did make you this money. And if you like that plan, then you can go ahead and put it in the exchange. That's planning the trade and trading the plan. But I want to point out a couple of correlations that are interesting here. First of all, even though what happens is, even though you're just doing a basic DCA down, you're just doing a basic double, multiplier of 2 right here, right? The more money you make is dependent upon how much further the market goes down. Now that's an interesting observation, and that observation only gets broader when we go up to a 3 multiplier. Look at how much more money we make when we use a 3 multiplier versus a 2. Right? 0.2 BTC, okay? We had to spend, however, and again, look at what's being informed, 1.788 BTC at the bottom of the market. You better have this allocated if you want to execute this plan. If you can't do this, this plan's no good. If you can't do this, you need to change something about this plan. You need to remove one of these numbers. You need to not buy right here. This is telling you that you can do this, or you can't. This is all on paper. This costs you nothing. Nothing about what we are doing costs you anything, and yet it absolutely informs just how much money you would have actually made if you had been doing this all year in 2018. If you had been doing this all year in 2017. If you had been doing this all year in 2016. It informs exactly, scientifically, inarguably, testably, repeatably, just by simply applying this price sheet and doing what this tells you, whether or not this would have worked, whether or not this would have made you money, whether or not this is profitable, whether Sensei Kevlar is talking out his ass or if this is real. You can test it, you can do the math, you can do it all right here. You can you can flux the numbers until it does exactly what you want it to do, until it hits exactly the right amount of profit that you're willing to take on in order to spend this much money. There is no way to cheat this. The only way to get this wrong is to get the calculations wrong. The only way to get this wrong is to not do it. Is not actually go in and put the money down ahead of time. To actually go put the buy order in at this ridiculously low price. That's the mindset of a trader. Is if they think it really can go down here, why not plan for it to go down here? Allocate. This is where we're going to make our money. And look how much more money we're going to make. The other thing that I want to point out to you is when we use a multiplier of 2, I want to point out something that's interesting. Right? As I pulled these numbers from, staring at the chart earlier in the day. Okay? And what I want to point out to you is when the market goes down, and it goes down 10%. Well, here it has to go, up 10%, up to 0.3, from 3.3 to 3.63. Sure, no problem. You're not making a lot, okay? You don't have to sell here. You can just let this ride. You can let this keep going, okay? But let's take a look at here, where we're at 3.1 and we're waiting for it to go up to 3.4. Well, that's interesting. That's because it's just above 3.3. In fact, if you look carefully, the next place that we're at, when we dollar cost average at 0.02, well, that brings our dollar cost average down to 0.0247. Okay, and the next place that we're waiting for it to go is 0.027. Well, that's awfully close to 0.03, which is where we bought the last time. You see, this is actually getting really close to just going ahead and selling at the resistance line, which was the support line that we predicted. Here we have 0.020. Well, that's exactly where we bought the last time. You see, these are actually moving in 10% increments. That's what the resistance is moving in. That's what that's how the market moves, is in these very stable, very predictable 10% increments. We'll talk more about this later, but I really want to point out that there are trends that are happening here. That a little bit more technical analysis, that's what we're talking about here. That's what this is. Technical analysis susses out. They show that there really is a correlation between how far the market moves and when it turns around again. So what I want to do is I want to not spend so much time figuring out how far the market needs to move before I actually get to the point where, I can tell you that it's not going to move anymore. It's going to turn around. So what I want to do is I want to apply automation to this analysis, where I'm sitting here staring at these numbers, copying them into a chart. I want to use the power of my computer in order to do all of this math for me and do some extrapolations of these types of analyses where I'm comparing the amount of motion between them. So let's see how we can do this, right? There is a Investopedia, DEI, there we go, the RSI, the Relative Strength Index. I'm just going to pull this up from Investopedia, okay? And it gives us the RSI. What we want to do is we want to take the information from a chart and we want to plug it into a calculation that gives us the information that we're looking for. The Relative Strength Index is a 2-part calculation that starts with this formula, and what it does is it uses the average gain or loss in order to compute a period of change, and then it plots that period of change over an oscillator. And an oscillator is just something, a chart that moves between 0 and 100. Okay, so what we're looking for is a chart. We're looking to get out of this a chart that tells us how much it's moved up versus how much it's moved down recently. Okay, so let's see if we can build this ourselves. What I have here is a worksheet which I have prepared for us. And what I want to show you on this is what I've done is I've taken a chart. Let me pull up the other chart here. I've taken the chart, and what I've done is I've taken the individual values of the close of the candles. Remember, a close on a green candle is that, let me zoom in here. A close on a green candle is the top right here. Not the top of the wick, but the top of the candle itself. A close on the red candle is the bottom of the candle. Green top, red bottom. That's the difference, right? A red is opens high, closes low. A green is opens low, closes high. Okay, so what we're going to do is we're going to take the close data, right? We're going to take the 0.035 of this red, and we're going to take the 0.036 of this green, and we're going to take the 0.039 of this green, and we're going to plug this in as a series of data that we want to analyze in our chart. Okay, so that's what this is right here. I'm just going to make up some numbers because typing all those fractions is tedious, and we can pretend that these are in dollars if we like. Really doesn't matter. The numbers all work out the same. The idea is we need to create the formulas that analyze the relationship between these formulas. So what I'm saying is, on the first day it closed at 36, on the second day it closed at 35, then it went to 38, 40, 45, 38, 38, 36, 30, 26, then it dipped down a bit here, okay? What I want to do is I want to extrapolate the difference of change between these things, okay? Well, it's a very simple formula. It's subtraction. It's if we gained anything, then we put that gain, the difference of that gain, in the gain column. Okay. So what that looks like is, if A3 minus A2, it's A3 minus A2, is greater than 0, then we do A3 minus A2. Otherwise, we're going to put 0 because we had no gain. For this period right here, we had no gain. It's clear to see that the loss is 1. So this is just the same formula in reverse, A2 to A3, greater than 0. If A2 to A3 is greater than 0, then we're going to do A2 to A3, which is subtracting this from this. Okay. So this is the amount of loss between this. Okay. Here we have 35 to 38. That's a gain of 3. Loss of 0, of course, right? We didn't lose anything here. Here we have 38 to 40. That's a gain of 2. Loss of 0. 40 to 45 is gain of 5, loss of 0. Then we lost 7 right there. That was a big loss right there. Here we have a big fat 0. Here we have a loss of 2, loss of 6, all the way down. Here's the gains, here's the losses. Okay. Then what it said is what we want to do is we want to compute an average of these. Okay, say we want to use a look back window of 5 to look at the average of these, to look at the difference in change, right? So if we were to do that, what we would do is we would take these 5 values right here, we would sum them up, and we'd divide by 5. That's because that's how you find an average. Same thing over here, right? What I've done is I've taken that, is I've gone ahead and I've said the average of B2 to B6. That's these right here. And I've said that this is the average of C2 to C6. So what I've done is I've computed the average gain and the average loss looking 5 periods back. Okay? And here I did the same thing, except I looked 5 periods back, which means I excluded this number. And here I did the same thing, which means I looked 5 periods back, which means I excluded these 2 numbers. So you can see there's like a sliding window. The window slides down of what we're taking our average from. Okay, we're doing that for each of these, and we're computing the average gain over a time frame. We're computing the average loss over a time frame. We can increase that time frame. We can make it longer, but we're just using 5 as an example. Right? And then what we're going to do is, according to the RSI, here's the RSI right here, we're going to take the average gain and we're going to divide it by the average loss. We're going to take the result of that, add 1, divide that by 100, or divide 100 by that, rather, and then take that and use 100 to subtract 1 from it. And that gives us the RSI. Okay? So what this is doing is this is creating our oscillator. This is showing us the difference between 0 and 100 and averaging out that difference, okay? So here's what it looks like in reality. Is what you do is you take the average gain and the average loss, right, which is D6 divided by E6, that's what we said, right here, the average gain and the average loss, D6 divided by E6, okay? And we take that and we say, here in this case, F6 plus 1 take that, divide it by 100, 100 minus. That's this formula right here. Played out in an Excel sheet. Okay. And what we end up with is we end up with a number between 1 and 100. It's always between 1 and 100. And what we see is as this number, as the amount of average gain moves up, then the RSI in turn moves up. Okay? So as we get a window with lots of gain in it, then we tend to have high values for the RSI, and then the RSI moves up. Okay. Then when the RSI moves down, when the average amount moves down, what we see is the RSI move down again. Okay. Because what happens is we get a moving average of the difference of change. So this chart right here is our original chart. This is the closed values right here. Right? We went 36, 35, 38, 40, 45 all the way up to here. Okay, 38, 36, all the way down to here, and this is how the original chart looked. Okay, down here is that plot against the RSI, and of course the first couple of values we don't have any values for because we don't have any values to look back upon, so it doesn't really start until right here. But what we can see is that when the chart is moving upward very quickly, the RSI also tends to move upward very quickly. And when it moves downward very quickly, the RSI also tends to move downward very quickly. Okay? And then when the RSI comes back, when the chart normalizes again, when it reaches sort of a steady state, the RSI tends to average towards 50. So long as the chart is going sideways, it'll move back towards 50 and then stay at 50. Okay? It'll take any motion and it'll show you the motion relative to the prior motion. What we're showing is we're showing motion relative to prior motion. Now, obviously, this is a ridiculously tedious process. A lot like this is a ridiculously tedious process. And the reason that I'm showing you all of this and going through all of this is I really need you to understand the relationship between these numbers and this graph and this graph, and how we go through this transformation of formulas using moving averages, division, and then an oscillator to create a new chart that is correlated and is an analysis of the change over time. Okay? Obviously, I don't want to do this by hand. That would be ridiculous. What I want to do is I want to have the computer do it for me. Let's get rid of all of this. I'm just going to kill this. That's much better. What I'm going to do is I'm going to come up here and I'm going to click on the indicators button. And I'm going to pull up the RSI, the relative strength index. Now, what this is showing me is the formula that I just painstakingly typed into Excel. Spent a lot of time going over it, showing you all the relationships about how to get to this chart. The point, though, is that the result is an oscillator. Here's 0, here's 100. And I've gone ahead, it's gone ahead and it's created these lines for me where it says at 70 and 30, just to show me a correlation that's interesting. Okay. Looking back historically, when the RSI has moved above 70 or 80, these have been times when it's about to undergo a downturn. Historically, when the RSI has been below 30, these are times when it's about to undergo an upturn in price. Okay, here the RSI was at 80, and look at what happened next to the price. Okay, here the RSI was down here at 20 or 25. Could this have been a good time to buy? Okay, so prior to now, what we've been doing is we've just been buying every single support and resistance line that we come across. Okay. Every single one that we can get our hands on. Because we've got the money and we can do our planning that way. Well, it turns out, you know, maybe we don't have an unlimited portfolio. Maybe we need to be a little bit more thrifty about how it is we're doing our spending. Maybe we need to be doing a little bit smarter about when we think the market actually is going to go back up, and not just spending blindly on every single time the you know, it hits a support point or a former resistance point. Because that's certainly a valid strategy, but it doesn't always work. But let's take a look at what happened here. Let's take a look at what happened when we added the RSI as an indicator. See all these times right here when we came up against this resistance, or this support right here? And then we bottomed out again? Look at where the RSI was. It was up here at 30. If we were waiting for the RSI to get down to 25, could we have not bought these levels and waited for it to come down before we dollar cost averaged? And here is the first time that the RSI hit. So would this have been because we have skipped this on the RSI telling us no? Could we have applied a rule that said we only buy resistance points, or sorry, support points or resistance points that you know, former resistance points that we think could become support when the RSI is below 25? You know, it certainly would have kept us out of this buy right here, but it would have brought us into this one right here. So it would have kept us out right here, but would have brought us in right here, where we thought we might have, you know, got a buy opportunity right here. The RSI said no. Or we thought we could have got a buy opportunity right here. The RSI said yes. Same thing going up. Is it time to sell right here? Well, the RSI certainly is telling us something, isn't it? Is it time to sell right here? Well, we've got two peaks of the RSI, and one is higher than the other. I'd say that's an even stronger signal it's time to sell. And look at what happened next when the RSI goes that high. Well, it just comes down again. Well, look at where the RSI was when we hit this, you know, when we hit these support levels right here. This is an opportunity, according to the RSI. Is this an opportunity according to the RSI? Not so much. This is an opportunity to already be in, because according to the RSI, we're seeing a trend reversal. Okay. So let's take a look at some more trend reversals. First of all, anytime you want to see a trend in action, just draw two lines between it. Okay. You can definitely see a lot of these, especially when you're in a down market. You're coming down like this. All I did was I drew a line between this and this right here, and I extended it into the future. All I did was I drew a line between this and this right here, and I extended it into the future. Okay. So we've got decision time coming up here, according to this trend line. According to this trend line, this is the sideways downward channel that the bear market has been moving in. If we get to this date right here, guess where we need to be to continue this bear cycle? We need to be somewhere below this price right here, after this date. Otherwise, this trend is invalid, and we can see a new trend. Okay? We can see this happen over and over again, right? Let's go take a look at that trend, at that same thing happening in the market. I'm going to take this line and this line. I'm just going to pull them on down, because look at what happens. Okay? I'm just going to go ahead and extend that into the future. Well, if we were plotting that trend line, and we got to this date right here, look at what happened on that date. If we were plotting this trend line right here, and look at how that trend line got respected. Look at what happened on this date right here. We were headed up, but on that date where we intersected that trend line, we went sideways. And then we tried to follow that trend line on down. But what happened as soon as we broke that trend line? What happened as soon as we broke the trend that kept us down? We went up again. What happened when we broke the trend? Oops. Sorry, that was the wrong tool. What happened when we broke the trend that had us going up again? Okay. We're going up, we're going up. It was time to make a new high. This was the time to make a new high. And look at this trend right here. Okay. There was the channel we were in. And you see that that got respected over and over. It got respected here, where we went back down to here. It got respected to here, where we went back down to here. It got respected to here, where we went back down to here, and look at what happened the minute it broke. The minute that this trend broke, we were in a new trend. Anybody starting to see the trends here? Okay. Take a look at this wedge right here. This is fairly horizontal support by increasingly low resistance. If you see fairly horizontal support with increasingly low resistance, that's a wedge that points down. Where is our decision point? Well, it's right here. The minute that it breaks through this, can we count on a new trend? I think we can. Okay. And there was the trend that we were in for that time. But there was our decision point right there. Then we're in this trend right here. All I did was I took it through that point, and I put it through that point, and I extended it into the future. And what happened when that trend got broken? Well, we went down again. Okay, which gives us a new trend. There's that trend. From there to there, extended into the future. What happened when that trend got broken? Here we are into a new trend. Okay, so what we're doing is we're building up a series of indicators. Look at these indicators, right? Look at this trend indicator right here that we built. Right? You could say that this is a trend right here, certainly. Right? Going from right here to right here. Look at how many times that was respected. Look at where our decision point was. It was here, on this day. On this day, we broke out the trend. Are we starting to form a new trend? You bet we are. Okay. We need to see where that trend is going now. But we're coming up on decision point, right? We need to see this trend get expanded out into this direction. Otherwise, if we break this trend right here in a matter of days, literally a matter of days, can we see a new trend down in this direction? Absolutely we can. Can you plan accordingly? Can you modify your plan, knowing that the RSI is telling you get out, get out, get out? Absolutely you can. Can you make more plans to buy down here? Absolutely you can, if you know where down here is. So what I showed you earlier is I showed you the correlation between how numbers move in percentages. And as it turns out, that's actually a really interesting correlation, because what you find is that things tend to move in standard deviations. A standard deviation is a percentage at which you expect a standard, something that follows a standard distribution to occur, right? 34.1% of the time, it's going to move in one standard deviation. 13.6% of the time, it's going to move within 2 standard deviations. 2.1% of the time, it's going to move within 3 standard deviations, and less than 0.1% of the time, it will move in 4 or more standard deviations, if the distribution is normal. So, let's measure the distribution. In order to do that, what we want to do is, the other thing I want to point out about this is connected to the Fibonacci. The Fibonacci sequence and the Fibonacci spiral, because what happens is that what you're doing is you're expressing the ratio of standard deviations within these numbers, right? Is each number is a standard deviation distance from the next. So each number represents that standard deviation, and by plotting this spiral, you can actually see those relationships of those standard deviations, right? Is, this is big, this is this much bigger than the next, which is this much bigger than the next. Okay, so let's see how all this actually plays out in reality. See if we can measure some standard deviations. Okay, what we know, let's get rid of all this crap. Goodbye. What we know is we expect the chart to move within a standard deviation 34.1% of the time. Okay, which means that 67.6% of the time, or whatever it works out to, it's gonna move in in more than one standard deviation. So let's see if we can measure that by extending a Fibonacci sequence along a movement. Okay, this is called a Fibonacci retracement. What I'm doing is I'm going over to my drawing tools and I'm picking the Fibonacci retracement tool. What I'm going to do is I'm just going to measure a market motion. I'm just going to pick one here. I'm going to measure from the bottom here all the way to the top right here. Okay. All I've done is I've just clicked right there. I'm not going to click again. What I'm going to do is I'm going to drag my mouse up here. I'm going to extend it over to the right. Oops, wrong button. I'm going to click right there. I'm going to drag it up there. I'm just going to drag my mouse cursor to the right. Get that line lined up right there on that peak. Then I'm going to click again to drop that tool. Okay. And what I'm measuring is I'm measuring standard deviations. Okay, and what we expect is that we can actually see what those standard deviations are here. Right? What we're measuring is we're measuring percentages, and we're measuring those percentages along the standard deviation. So here's the 50% mark, which is 0.5. So this is halfway up the motion. This represents halfway point of the motion. Now, according to the Fibonacci sequence, the spiral, the relationships between them, the standard deviations between them, the next ones from the 50% is the 32% higher. So you get 38.2% and 61.8%. Okay? So what we expect is that if this thing really is true, if the market really does move within standard deviations, we expect that it should stop on the 61.8% and the 38.2%, the inverse of or at least 32% of the time, and possibly much higher. Okay, so let's see if that's true, right? What we're looking for is we're looking for correlations. And sure enough, when the market came flying back down, okay, let's say that we just knew this. Let's say that we were in the past. Let's draw this like we're in the past. So the market went flying up on us. Like, oh my goodness, have you seen what the market is doing? Okay. First of all, we can already measure that the market did turn around right here, which means that this is a standard deviation of this motion, right? This is probably 200% of this motion right here. And what we can do is then we can say, well, it also did it right here. The market stopped at a standard deviation right here at the 23.6 mark right here. It didn't even pause at this one, it flew right through it. But let's see if we assume that the market is going to move within these standard deviations. If we assume that the market is going to move within the standard deviations, then it should have stopped here, and it did. And it should have paused here, and it did. And definitely should have, done something here, and it did. And then, here's the total of the motion, and now the market's going to come back down. Can we predict that this is going to become a resistance line based on nothing but the standard deviation? Can we predict that this is going to become a resistance line based on nothing but the standard deviation? Let's find out. Let's drag it to the right here. We already knew what the numbers were ahead of time, so we went ahead and placed our trades, especially on the 38.2 and the 61.8, because those are the most common ones. Those are the ones that are going to happen most frequently. Sure enough, as if by magic, it came down and it hit that standard deviation, and it went back up, and it came down and it hit that 61.8, and what did it do? It turned around again, and it went up to the 38.2, and what did it do? It turned around again. And then it came all the way down, and it came all the way down back to right here before it started going up again. Look at where it is. Look at where it stopped. Look at where it stopped here. Go ahead and pull that out even further. It stopped just short of the 78.6 rather. It stopped just short of losing 78 of regaining that 23.6% mark on a standard deviation. If I had plotted this in reverse, you'd see it, because instead I would be doing this. I'd be doing from here down to here, except I want to extend it in this direction. You can see that it recovered that 23.6 of that fall. Here's the 100% of the fall. Here's 23.6% of the fall. Came right up to it. It should have stopped here. It should have stopped here, if it was following standard deviations. Now, is this magic? Is this wizardry? Is this, just mathematical, like, what the hell is going on here? No. The explanation is really, really, really simple. Allow me to explain. These tools, these motions, these patterns, these have been around since the 70s. Traders are using these tools. Traders are making these predictions. Traders are doing exactly the same thing that I am doing. So when they go to program their bots, when they go to program their orders, when they go to put in their plan, when they go to make their plan, you better believe that this is where they make their plan. This is where they plan to be doing their buying, right here at this level. Well, if everybody plans to be doing this doing their buying at this level, right here at the 38.2%, at the 61.8%, when RSI is here, when RSI is down here, if everybody plans to be doing their buying right here, why? Because we're at 38.2, we're at 61.8. Why? Because RSI is at 16. RSI is at 14. If everybody plans to be doing their buying right here, well, guess what? Everybody does their buying right here, the market goes up again. Well, if everybody sees that, the trend got broken, that this happened, that all, we're here on the 61.8, look, as soon as we get above the 61.8, everybody programs their bot to sell. Everybody programs their bot to sell. What happens next? The reason that these indicators work is they're literally self-fulfilling. They're like prophecies that say, this is what's going to happen because everybody's going to do this. And if everybody believes that everybody is going to do this, well, they're going to act in their own best interest and put their buy orders in here too. Why? Because we're below the 38.2. Why? Why put your sell orders in? Because we're above the 61.8. Why? Because the RSI is here. Can we build a mathematical formula out of this? How about a scoring system? Is it time to buy? We're looking for 4 points. Number 1, are we at a resistance level or a support level? Number 2, what is the trend telling us? Has the trend been broken? Number 3, what does the RSI say? Is it below 20? Number 4, are we at a standard deviation, above or below a standard deviation? If we just apply those 4 simple rules over and over and over again, well, guess what happens? This, let me find it. This changes. If we apply these rules consistently, we're not going to be buying every single level, are we? We're not going to be buying every single number. We're going to be optimizing where we do our buying for where the market actually has the best chance of turning around, statistically speaking, knowing that it can always go lower. Knowing that this buy right here represents, this point in this point in our plan right here, knowing that that buy represents that point in our plan, that's our, second or third buy, knowing that we may need to be buying down here if it continues to go down. Fortunately, we made money. Woohoo! Lots of money. Love making money. Time to sell. Time to execute that 10% strategy. Time for it to go up 10% and sell half of our money. So there's another way of doing this, right? Instead of just selling everything, instead of getting here and taking all the profit, sell half your position. Then wait for it to go up 10% more and sell half your position. Or wait for it to go up to the next position and sell half your position. If you 50% your position every time, you always got some left, but you're taking profits. Well, nobody ever went broke taking profits. How you actually execute this strategy is what makes you the trader you are. How you sit here and plan out your standard deviations, how you map your rule set against reality, against this, how you make sure that you actually have the money in your account ready to go. This much is how I'm going to be allocating for this opportunity. How you plan the trade and then trade the plan is what makes you the trader you are. And that is the way of the trader. Well, I really hope this has been informative. And I look forward to tomorrow's live charting session and then Friday's lesson where we're going to really take this to the next level. I invite you all to spend some time going over some charts, drawing these trend lines until you can see them in your sleep. And please, sit down and make a plan. And if you get tired of doing the formulas on a calculator, then start typing the formulas that you're doing into an Excel sheet. This is not going to help you because these numbers aren't real, but I'll share it with you. Can view. And we'll make it so anyone with the link can view it. And now it's in the dojo. But please, don't just copy this and start typing your numbers in. Understand the value in these formulas. Understand the formulas themselves and how they got here. Understand what happens when you do this. Understand what happens when you wait for this. And how much more you get and how much longer you have to wait. Do the planning on paper first. Make all of your money on paper. All of it. Plan the trade and trade the plan. And that is the way of the trader. Thank you all very much. I look forward to tomorrow's session, and if you have any questions, please feel free to ask them in the dojo. Good night.